Hi everyone, welcome to the latest TM Brunston Market Update. I hope that you're all keeping safe and well as we continue to ease into the new normal. I'm pleased to have with me once again Mark Shields, Brooks McDonald Investment Manager, and we will be covering a few topical questions. Hi Mark, thanks for joining us again.
Hi there, Brian. Pleasure to be here.
Good. Mark, the investment funds thankfully are performing well, and looking at the adventurous and the cautious funds at the moment, what is the rationale for holding UK assets in the portfolio?
Yeah, this is a common question we're having at the moment. Really, clearly a lot of growth within portfolios has been driven more by international assets rather than domestic assets, so UK assets. And indeed, the economic situation within UK has arguably deteriorated over the summer months fairly significantly. And we're going into a much more different environment now than we were 6 months ago. However, I think one of the things that is very frequently overlooked when it comes to UK assets is the valuation differential between the UK and global stocks. So, at the moment, if you do an aggregate of price to earnings, price to book, and price to dividends, sort of three of the main ways that you can value stocks or companies, on average, the UK market is sitting at its lowest valuation since 1975. So, what you're able to do by getting exposure to the UK is to essentially buy companies that are, in some cases, many cases, globally exposed companies at a significant discount to their more international peers. And that is the main reason at the moment that we continue to favour the UK, is that valuation bias that we're able to obtain within the portfolio, and the exposure to the cyclicality or the cyclical companies that we expect to do well, or have the capacity to do well if investors remain focused on that valuation position.
Okay, okay. So buying it, hopefully a discounted value at the moment for future growth in particular. Moving on to thoughts on inflation, Mark. We have quite a few questions on this and how indeed it can affect the portfolios. What's your current thinking on this?
Yeah, again, very topical. We've seen inflation sort of rear its head again, kind of really the early part of September, and it led to quite significant market falls throughout much of September and really into the sort of middle part of October. We've seen quite a significant recovery since then, but yeah, inflation is becoming more at the forefront of investors' minds. And in fact, now within places like the UK, it looks likely that we're going to get at least one rate rise before the end of this year. And indeed, expectations for rate rises in 2022 have been brought forward as well. So there is increasing concern regarding inflation and the action that central banks are likely to take. For what it's worth, we're still seeing the main sort of the key central bank being the Fed over in the US. They're sort of holding their ground much more, and haven't really alluded to any significant movement with regards to increasing interest rates. Unlike the UK, there are some factors affecting the UK which are quite sort of unique to us over here, which is making the MPC at the Bank of England be more hawkish. However, our base case remains that we anticipate inflation to be transitory. We're still not seeing this inflation, or the main factors that are driving this inflation feeding through into areas such as wage growth, which is one of the key parts that makes inflation become more kind of endemic and sustained in economies. So we continue to think that this is a transitory inflationary period. We continue to think that actually we're likely to remain in a relatively low interest rate environment, broadly speaking. Um, However, we have taken some measures to protect the portfolio, especially in the cautious fund, which obviously has a much higher exposure to fixed interest assets, and those are more prone to be negatively impacted by interest rate rises or inflationary rises. And we've increasingly focused our fixed income exposure in the cautious fund to short dated debt, which is much more resilient to inflation and interest rate rises. So we hope that even if our base case of this being a transitory inflation narrative is incorrect, we hope by doing that we've given ourselves some protection in the portfolio if the inflation story sort of worsens further from here, shall we say?
Okay, so hopefully the return to 17% interest rates back in Maggie Thatcher's days are a long, long way
I
off.
I severely hope that is not going to be the case at all. And for what it's worth, central banks I think are very very aware of the fact that if they do raise rates very quickly, very high, that's not going to be sustainable for economies, given the level of debt that is currently, especially at a governmental level. So the likelihood of that is low. But again, it's something that we're protecting ourselves against a little bit.
Okay, thanks. Moving on now, Mark, to China. They've been in the headlines quite a lot of late with the Evergrande situation. Do you see that this is in any way likely to derail markets?
Yeah, again, we've seen a lot of focus on China. Initially, there was the changes that the Chinese government made to regulations around gaming, education, and other parts of their economy. Essentially, they want the economy to be more refocused on parts of the economy that they deem to be productive, and they don't sort of believe that areas such as computer gaming is a terribly productive way for individuals in China to spend their time. That morphed somewhat going on over the next couple of weeks, really, as investors then became focused on Evergrande, which is the world's most indebted property company. And there were some warning signs that started to emerge regarding their ability to repay debt, especially offshore dollar-denominated debt to foreign holders of that debt. Um, and then there was a bit of a sort of concern that this was going to lead to China's Lehman's moment. And if you remember, in the great financial crisis of 2007, 2008, it all started essentially with property companies unable to borrow from banks in order to maintain their position and pay off the debt that they had, which then spiraled into essentially the failure of Lehman's, and the central governments having to step in to rescue major banking institutions. There was a concern that this was a similar situation within China, but the key difference, the really key difference here, is the fact that in China, the banks are all state controlled. So at the moment, the Chinese state is telling the Chinese banks that they have to continue lending to these property companies, even though they're highly indebted, and normally within the West they would struggle to raise any finance. So that is a crucial difference, that the Chinese government is willing to step in immediately via their banks. And in fact, we haven't seen any reduction in the amount of money that is being lent to Chinese property developers since the Evergrande issue started to rear its head. So I think that the likelihood of this being China's Lehman's moment is remote, because China has a much tighter control over its banking and financial system than the West did, sort of 15 years ago, or so. And the likelihood that this is going to cause a further turmoil, I think, is becoming less pronounced as time goes on, especially as Evergrande seems to be able to be offloading some of its assets, some of its divisions. It has now made an offshore bond payment that was being awaited for, and it can still tap into some finance from the state banks. So I don't expect it to be a major global issue. I don't think Evergrande will exist in the same way it has done before, and it may well be that China lets Evergrande itself go essentially disappear, with assets sold off to other property companies, and more stringent measures brought into that property space within China. But the likelihood of it being a contagion, I think, is now unlikely.
Okay, thank you very much, Mark, for that. Thank you for those insights. As always, if you have any questions, then please be in touch with us. Thank you for listening.